Chasing a 10% dividend yield often destroys your portfolio faster than inflation. Most investors ignore the hidden tax drag and payout erosion that turns a high yield trap into a net loss. By crunching the data on S&P 500 aristocrats versus high yield REITs, we can isolate the exact tipping point where growth compounding obliterates raw yield. It is time to look at the math that actually builds lasting wealth behind your future portfolio. Most people treat dividend investing like a simple hunt for the highest percentage. You look at a stock, you see a 5% yield, and you think you have found a winner. It is the classic trap of chasing yield. You see that shiny 5%, but you ignore the underlying health of the business or the potential for that payout to actually shrink over time. Let us start with the easy win, dividend growth. This is the strategy favored by legends like Warren Buffett, though he prefers to let his companies do the growing for him. Imagine you buy a stock today that yields 2%. It sounds low, right? But that company raises its payout by 10% every single year. In 10 years, your yield on cost, the amount you receive relative to your original investment, is no longer 2%. It is over 5%. By year 20, you are sitting on a yield on cost of 13%. This is the magic of compounding, and it is why dividend growth is the engine of long-term wealth. A famous study by Ned Davis Research analyzed the performance of S&P 500 stocks from 1972 through 2022. They found that dividend growers and initiators outperformed companies that simply maintained their dividends or paid none at all by a massive margin. While non-dividend payers returned about 7% annually, dividend growers returned over 10% with significantly lower volatility. The reason is simple. To pay a dividend, a company must generate cash. To raise that dividend, it must grow that cash. A company that increases its dividend year after year is sending a loud, clear signal to the market that it is profitable, disciplined, and confident in its future. That is the first pillar of your strategy. Now, here is where things get interesting. What if you want cash today? This is the level up. This is where we look at dividend yield in its proper context. Sometimes you need the income now. Maybe you are nearing retirement or you want to reinvest those dividends into other ventures. The problem is that high yield is often a sign of a distressed stock. When a stock price tanks, the yield, which is the dividend divided by the price, spikes. If a company is yielding 8%, you have to ask yourself why. Is the market pricing in a dividend cut? Is the business model failing? I remember a friend who went all in on a telecommunications giant in 2018 because of its massive 7% yield. He thought he was smart. He thought he was getting a deal. But within 2 years, the company slashed its dividend by 40% to pay off mounting debt. His share price also plummeted, meaning he lost both his income and his capital. The lesson here is that yield is a trailing indicator. It tells you where the company has been, not where it is going. If you find a stock with a high yield, you must check the payout ratio. That is the percentage of earnings a company pays out as dividends. Anything consistently over 60 or 70% is a red flag. It means the company has no room to maneuver if things go wrong. If you are finding this helpful, please hit subscribe. I release these deep dives every week, and sticking around helps me keep the lights on while we break down complex financial data together. All right, now for the one I have been saving. This is the strategy that changes the game entirely. Forget picking just yield or just growth. The secret is the dividend growth rate trajectory. You are looking for a company with a respectable starting yield, maybe 3%, and a consistent double-digit growth rate. This is the Goldilocks zone. You get enough cash to feel good about the investment immediately, but the growth keeps your purchasing power ahead of inflation and builds your wealth exponentially. Think of companies like Microsoft or Visa. 10 years ago, their yields looked mediocre. But because they grew their earnings and their dividends at such a blistering pace, they have become income machines for shareholders who had the patience to hold. Here is the data point that blows the others away. According to data from the Hartford Funds, dividend growers have historically maintained lower risk profiles during bear markets. When the market dropped by 20%, dividend growers tended to fall by only 15%. They act as a shock absorber for your portfolio. That is the hidden superpower. It is not just about the money you make. It is about the money you do not lose. Once you see it this way, you cannot unsee it. You stop looking for the highest number on a stock screener and start looking for the most durable business model. You begin to value the company's ability to allocate capital rather than just its ability to pay you a check. So, how do you put this into practice today? Start by filtering for companies that have increased dividends for at least 10 consecutive years. Then, look for that payout ratio below 60%. If it meets those two criteria, you are already ahead of 90% of retail investors. Then, look at their free cash flow. Are they paying the dividend out of actual cash or are they borrowing money to pay you? If they are borrowing, run. If they are paying from cash, you have found a potential compounder. There you go. We have covered the growth strategy, the trap of high yields, and the power of the dividend growth trajectory. That third method alone, focusing on the combination of moderate yield and high growth, could be the foundation of $1 million portfolio over the next 2 decades. It is not about getting rich quick. It is about getting rich for sure. If you enjoyed this video, hit the like button and share it with a friend who is currently obsessing over high yield stocks. It might just save them a lot of heartache in the long run. Stay tuned because in the next video, I am going to show you how to automate this entire process using a simple 3 bucket system. You won't want to miss that one. Thanks for watching, and I will see you in the next one. The market is a machine that transfers money from the impatient to the patient. Remember that as you build your positions. Every single day you stay invested with a quality company is another day where the odds shift in your favor. Just keep going. Best time to start was yesterday, but the second best time is right now. Go take a look at your portfolio and see if you're holding winners or just high yield traps. That distinction is the difference between retiring in comfort and working forever. I hope you choose the path of the compounder. It is the only one that lasts.